So you're asking, how's real estate? Well, let's get right into this week's update because the big story is about interest rates. The Federal Reserve just lowered its key interest rate by a quarter point down to about 3.9%. This is the second time they've cut rate this year. They're doing this to help support economic growth and hiring, which has slowed down a bit. Now, this Fed rate isn't the same as the mortgage rate you see advertised, but it does influence it. A cut like this can gradually help lower the cost of borrowing for everyone, which includes mortgages, car loans, and business loans. The Fed is trying to find a balance. They want to keep the job market, but they also have to make sure inflation doesn't spike again. It's a tricky situation, and it's made even harder because the government shutdown means they aren't getting their usual reports on job and inflation. They're having to rely on private sector numbers to make these big decisions. Here is the more immediate good news for homebuyers and homeowners. The average rate on a 30-year mortgage just dropped for the fourth week in a row, landing at about 6.17%, which is the lowest we've seen in over a year. To give you some perspective, just last year, that same rate was up at 6.72%. This is a big deal because a lower rate directly boosts your purchasing power as a buyer. It also means it could be a great time for current homeowners to look into refinancing to get a better rate. Even with that good news, the Fed's being cautious. The Fed rate, Jerome Powell spoke this week and basically said not to assume another rate cut is coming in December. He said it's not a foregone conclusion, far from it. There were apparently strongly differing views on what to do next. Again, the main problem is the lack of clear data. They're getting some information, but they don't have the detailed picture they're used to. Powell mentioned that the job market does look somewhat softer, and that hiring has slowed down. On inflation, he said something interesting. He pointed out that if you take away the effects of recent tariffs, our inflation is actually not so far from their 2% goal. But at the same time, other parts of the economy, like consumer spending, have been stronger than they expected. So, the main takeaway is that we're seeing some very positive movement with mortgage rates, which is fantastic for the market. But the Fed is still in a wait-and-see mode, trying to navigate a complex situation without all its usual tools. That 6.1.7% rate is definitely the headline for anyone thinking about buying or selling right now. Talking about interest rates, we've all know mortgage rates have been high. And it can feel like you have no control over the market or what you'll end up paying. But a new study just came out from Realtor.com that's actually pretty encouraging. They looked at almost 2 million loans and found that what you do as a borrower can make a huge difference in your monthly payment, even more than what the general market's doing. For example, back in 2024, when the average rate was about 6.6%, some buyers were still getting rates as low as 6.25%, while others were paying 7%. On a typical $425,000 home, the person who got the lower rate will save over $60,000 more than the person with a higher rate. That's a massive difference. It shows you have more power than you think. So here is the single biggest takeaway from the research. Shopping around for your lender is the most powerful thing you can do. It's also the easiest. The study found that the difference between the most expensive and the least expensive lender for the exact same person could be over half a percentage point. That might not sound like a lot, but on a $425,000 home, that half point difference saves you $122 single month. Over the life of the loan, that adds up to almost $44,000 back in your pocket. The best part is anyone can do this. Unlike saving for a bigger down payment, every single buyer can take the time to compare offers from a few different lenders. Now, let's talk about your credit score. Of course, a high score helps, but the study showed where the biggest benefit comes from. The most important jump isn't going from great to perfect. It's from having a good score, say in the high 600s to or low 700s, to a very good score, which is generally above 720, 740. Making that improvement can save you thousands of dollars, around $8,700 over the long run. The point is, you don't need a perfect 800 score. Just moving up one tier makes a real difference. The other big factor is your down payment, and this is where the savings can be huge. The study found that crossing the 20% down threshold is a key milestone. If you can go from putting 10% down to 20% down on that same $425,000 home, the combination of a smaller loan and the better interest rate could save you over $100,000. Of course, we all know that saving that extra $42,000 is a huge challenge for most people. That's exactly why understanding these other tools is so important. You can't always double your down payment, but everyone can compare offers from different lenders. Main message is that even when rates feel high, you are not powerless. Focusing on what you can control, like shopping around and improving your credit, can make a real, measurable difference in making your home more affordable. Now, here is a breakdown of what's happening in the housing market across the nation based on the new report for September. I was just looking at the latest national report, and it seems the market picked up a bit in September. Sales of existing homes, so not new construction, climbed by about 1.5% compared to the previous month. It's a modest jump, but it shows activity is moving in a positive direction. The main reason for this seems to be that mortgage rates eased up a little bit. The chief economist for the National Association of Realtors pointed out that as soon as rates dip, it helps with affordability. And when homes become even slightly more affordable, it tends to bring buyers who are waiting on the sidelines back into the game. Now, let's talk about what's for sale. The number of homes on the market, or what we call inventory, is actually at a 5-year high. This is good news for buyers, as it means more choices. However, we are still seeing fewer homes for sale than we did before the pandemic. Most current homeowners are in a stable financial position, so we're not seeing many foreclosures or forced sales, which is keeping the overall supply tight. Because there are still more buyers than available homes, prices are continuing to climb, just not as quickly. The median price for a home across the country is now about $415,200. That's about 2% higher than it was this time last year. It's pretty significant that prices have now gone up year over year for 27 months straight. Bringing it down by area, the South was a real standout. Our region saw sales increase by almost 7% compared to last September, which was the strongest growth in the entire country. It really shows how much demand there is for homes in our area. A few other interesting details from the report. Homes are sitting on the market a little longer, about 33 days on average, giving buyers a bit more time to think. We also saw an encouraging sign. 30% of all sales were to first-time home buyers, which is a healthy increase from last year. Finally, cash is still playing a big role, with 30% of all transactions being all cash deals. Now, I wanted to share some interesting news about what's happening in the Florida housing market based on the numbers from this past September. Looks like the market's picking up some real momentum. We saw a significant increase in home sales compared to this time last year. For single family homes, sales were up 13.6%, and for condos and townhouses, they were up 8%. That jump in condo sales is especially noteworthy because it's the first time in 17 months that we've seen a year-over-year increase for them. So, you might be wondering why we're seeing the sudden boost in activity. Really seems to be tied to mortgage rates. Back in August, rates dipped a bit, hovering just above 6.5%. That slight dip seems to have been enough to bring a lot of buyers back into the market. Since then, rates have fallen even further, which is making it possible for more people to find a home that fits their budget. Now, let's talk about prices, which is the other big piece of the puzzle. We are seeing prices level off, which is a sign of a more stable, balanced market. The median sales price for a single family home in September was $410,000, which is exactly the same as it was a year ago. For condos and townhouses, the median price was $299,000. That's actually down about 4.8% from last year. Just as a reminder, the median price is the midpoint, meaning half of the homes sold for more and half sold for less. We're also seeing some changes in the number of homes available for sale. We have more inventory than we did last year, but the rate of that increase is starting to slow down. A good way to measure this is months supply, which basically tells us how long it would take to sell every home currently on the market. In September, we had a 5.1 month supply of single family homes and a 9.1 month supply of condos. This is a part of the market finding a healthier balance. Looking ahead, we have good reason to believe this positive trend will continue. The number of new pending sales, which are homes that just went under contract, was up in September for the second month in a row. This is a strong signal that buyers are feeling more confident and that we can expect to see solid sales numbers continue into the fall. It really feels like the market has found its rooting and is moving in a strong, positive direction. When you buy a house and get a mortgage loan, you must get insurance. And if the house is in a flood zone, you must obtain flood insurance. But things get tricky with the government shutdown going on. Here's why it's a problem. The federal government is the largest provider of flood insurance in the country through a program most people know as the NFIP. Because of the shutdown, that office is closed. They literally cannot write any new policies or even renew existing ones. So if you're a buyer trying to get a mortgage for a home in a flood zone, your lender will demand that you get this insurance. But if you can't get the policy because the program is shut down, the bank won't give you the loan. It's that simple. This is causing home sales to get delayed and in some cases completely frozen. I heard about one situation from a fellow agent where their buyer was all set to close, but the bank denied them the mortgage at the last minute because they couldn't get the required flood insurance. That buyer had to scramble and borrow cash from several family members to buy the home outright, just to avoid losing the deal. They're planning to get a proper mortgage once the government reopens, but that's obviously a very stressful solution. Let's be realistic. Most people can't just call up their family and pull together enough cash to buy a house. That was a rare exception. For most buyers who need a loan, the shutdown just means their transaction is stuck in limbo. Now, you might be thinking, can't you just go get private flood insurance instead? That's a great question. And sometimes you can. Florida does have a small and growing private market. The issue is that for many properties, especially those in higher risk areas, the only option available has always been the federal program. When that program isn't available, those buyers have no other choice. What's really worrying is the flood risk doesn't pause just because the government does. We are still in hurricane season. It feels incredibly reckless to not have this program available right now. We are all hoping Congress can at least pass a separate bill to extend the flood insurance program, even if they can't agree on the rest of the budget, so that people can safely buy their homes and be protected. As a real estate agent, I see a lot of different market situations, and there's an interesting trend I want to talk about that affects many families. You might have noticed it yourself. More young adults are living with their parents, often well after college. The numbers really back this up. We're seeing about 1.5 million more adults under the age of 35 living at home compared to just 10 years ago. It's a significant shift in how people are starting their adult lives. The main reason for this change really comes down to affordability. It has become much harder for young people to find a place of their own. Over the last decade, we've watched rents and homes prices climb much faster than most paychecks. In many cities, rents have been rising steadily every year, while average wages for full-time jobs have barely kept up. When the cost of a basic apartment is so high compared to what you earn, living independently just isn't an option for many. When economists look at why housing has become so expensive, they often point to a simple problem. We don't have enough homes for the number of people who need them. In many areas, rules and zoning regulations make it difficult or expensive to build new houses or apartment buildings. When there aren't enough places to live, the competition for the homes that are available drives prices up for everyone. The situation has pros and cons. On the bright side, living at home is a fantastic strategy for saving money. I work with many first-time home buyers who were only able to save for their down payment because they lived with their parents. But experts also point out the downsides. Living at home longer might mean delaying other big life steps like starting a family or moving for a career opportunity. It can make it harder to build a fully independent life. In the end, most experts agree that the best long-term solution is to build more homes. If we can increase the supply of housing, especially homes that are at a price point that working people can actually afford, it could make a huge difference. It would give a lot of young people the chance to move forward and establish themselves on their own. You've probably heard the term floating around in the news, the silver tsunami. It sounds dramatic, but it's actually a pretty simple idea that's having a huge impact on the housing market right now. It refers to the massive generation of baby boomers who are generally between 60 and 78 years old. For the first time, this group has become the single biggest group of both home buyers and home sellers, which means they are really shaping the market for everyone else. So, why are they making such a big splash? Well, think about it. Many boomers have been in their homes for a long time, sometimes 15 years or more. Over that time, they've built up a ton of home equity. This gives them a lot of financial power. They can often sell their current larger home, take those profits, and use that cash to buy their next home. This gives them a huge advantage in the market as they make moves heading into retirement or just planning for that next chapter. This is leading to a few big trends that I'm seeing every day in my work. It really breaks down into three main ways people are handling this new phase of life. The first one is what most people call downsizing, but I really prefer the term right sizing. It's not always about getting a smaller house. It's about finding a home that fits your life right now. That might mean moving closer to family or just finding a place that's easier to take care of, perhaps with less maintenance or a smaller yard. I can tell you from experience, this is often one of the most emotional moves a person can make. You're not just selling a house, you're selling a home filled with decades of memories. My advice is always to start early. Take your time decluttering and focus on making the new place feel like home from day one. The second big trend is aging in place. This is exactly what it sounds like. A lot of folks simply love their current home and neighborhood and want to stay put for as long as possible. The main challenge here is that most homes just weren't built with senior living in mind. In fact, an AARP study found that only about 10% of homes in the US are truly ready for this. We're talking about things that can become a real safety hazards later on, like slippery bathtubs, steep stairs, or poor lighting. So many homeowners are now making smart updates. They're remodeling bathrooms to have a low curb or curbless showers, adding better lighting, and maybe even ensuring they have a primary bedroom on the first floor. It's all about making the home safe and comfortable for the long haul. And that brings us to the third major trend, multi-generational living. This is making a huge comeback with more families buying homes together than we've seen in a long time. There are a few reasons for this. It can make housing more affordable. It helps with caregiving for older relatives, or sometimes families just want to be closer. This is actually changing how new homes are designed. Builders are creating floor plans with the two primary suites or separate living spaces with their own small kitchens. You also hear about ADUs or accessory dwelling units. Think of a small guest house or an efficiency or a mother-in-law suite on the same property. It's a great setup that lets families be close, but still gives everyone their own space. So as you can see, the silver tsunami isn't just one thing. It's about right sizing, aging in place, and families coming back together under one roof. It's a huge shift in our market, and it's really changing what people are looking for in a home. And that's the real estate update for this week. If you found this video helpful, please give it a like. It really helps the channel grow. And I'm Albert Stepniak, a realtor with Coldwell Banker here in beautiful South Florida. Don't forget to subscribe and hit that notification bell so you never miss a weekly update. Thanks for watching, and I'll see you in the next video.